Good morning, guys. Today, me, Clarisa, and my partner, Monique, we're going to explain about the comparison between IFRS Indonesia, which is PSAK, and IFRS itself regarding revenue and expense. It was started by revenue and followed by expense. So, in general, revenue in PSAK 23 and IAS 18 is different. It's similar. Revenue is the gross inflow of economic benefits, and it forms part of income. And the definition of income itself is focused on 6 points, which is increases in economic benefits, and it has to be within accounting period in the form of inflows, and it could be in monetary or physical, or enhancement of assets such as account receivable, or decrease of liabilities that increase in equity such as unearned revenue or accrued revenue, and lastly it can be from investment from the shareholders. Income encompasses both revenue and gains and arises in the course of ordinary activities such as fees, interest, dividends, royalties, and etc. So the standard identifies the circumstances in which revenue criteria will be met, and therefore revenue will be recognized. It also provides practical guidance on the application of these criteria. But however, the primary issue in accounting of revenue is determining when to recognize revenue. So according to IAS 18 and PSAK 23, revenue recognition is when it is probable that future economic benefits will flow, and it can be measured reliably. But the question is, at what point during the earning process can revenue be recorded as earned because there is sufficient evidence? So revenue can be recorded as earned when there is sufficient evidence. For example, when the contractor will record building construction revenue as revenue, and so contractor will record it as revenue when there is a contract or penalties that will explain that the construction of the building will be more likely to happen than less likely to happen. And to measure revenue, it has to be probable, like more likely than less likely to happen, and reliable, like who said so, and is there any valid evidence to support, and also it has to be measured at the fair value. So PSAK 23 and IAS is similar in all significant aspects, except for in minor details. For example, in PSAK 23, they mention that the entity should disclose deferred revenue recognition, as in paragraph 43D. Meanwhile, in IAS 18, they did not mention any of deferred revenue recognition. And meanwhile, in IAS 18, they disclose any contingent liabilities and assets in accordance with IAS 37. However, in PSAK 23, they cannot adopt paragraph 38, which is this one, because they cannot adopt IAS 37. To make it clear regarding revenue recognition, I have a case. So X is management consultant was asked by Y to conduct a study on the feasibility of selling of a new product. The study was not completed until January 20th, year 10, and at the end of year 9, X estimated that she had rendered $2,000 worth of services. So the question is, should X record that amount as service revenue at the end of year 9? The answer is no, because until the study is completed, there is no sale of services. So the completion of the study is necessary to the meaningfulness of the study, and the last act must be performed before there is recognition of revenue. So that's all from revenue.
So next, I'm going to explain about the expense theory. So, expense based on the conceptual framework, by definition, is a decrease in economic benefit or asset during the accounting period. This is also include the losses or costs which arise from an ordinary activity of an entity. So, by definition, the losses is costs which may or may not arise from the ordinary activity of an entity. So, example of the decrease in asset is, for example, decrease in cash or cash equivalent, inventory, or fixed assets. Cost from ordinary activity is include the cost of goods sold, salary expense, and the depreciation. The next is about the losses. So loss is include the disaster, for example the fire and flood. The second one is disposal of the non-current asset. And then the third one is unrealized losses, for example the deflation of foreign exchange rate, which not realized yet, but it is only as an impact of a debt or outstanding receivable of an entity in that foreign currency. So those all normally present separately from income or expense of an ordinary activity, but might influence the economic decision of the share stakeholders. So next is about the comparison of both Prescott or the book with the conceptual framework itself. So actually the book is also using the same base, which is the conceptual framework. Therefore it is quite similar. However, the conceptual framework does not cover the three matching concepts. The first concept is associating cause and effect. It is actually difficult to prove, so accountants use the reasonable observation to decide that a certain goods and services used up must have help in the creation of the revenue. For example, is cost of goods sold. The second concept is systematic and rational allocation. It is actually recognized expense in the accounting periods in which the economic benefit associated with this item are consumed or expired. For example, like company depreciate their fixed asset over the year. The third concept is immediate recognition. It is all possibility which is not covered by the first and the second principle. For example, the advertising expense. So to make it a little bit clear, so I have a mini case. So a PT ADC purchased fabric at 5 December 2015 for 5,000. That used to produce clothes which sold for 8,500 at 25 December 2015. The question and when is the cost of fabric amounted 5,000 should be recognized as expense. So what is the answer? To determine whether it is an expense or not, we use the basic measurement of associating cause and effect. So we should recognize the cost of fabric for 5,000 when all the clothes produced by this fabric is sold, so which is at December 25, 2015. The cost of fabric is a product cost, so the cost of making a product is not an expense until the product is all sold, then it becomes the cost of goods sold. Yeah, that's all from me and Clarissa. Thank you.